Welcome to The Explainer. Today, we're going to pull back the curtain on our financial world. We're talking about the hidden currents of money and belief that are quietly redrawing the map of global power. And yeah, even changing the value of the cash in your wallet.
You know, this quote right here, it's from Michael Burry, the guy who famously saw the 2008 crash coming from a mile away. He actually shut down his hedge fund with this simple reason. The market just doesn't make sense anymore. And that's a feeling a lot of us have, right? That the link between what something is actually worth and what it costs has somehow been severed.
And that's really the central mystery we're diving into today. I mean, if the old rules of value don't apply, what rules are we playing by now? To figure that out, we have to start with the ultimate example of an asset that's driven almost purely by belief.
Okay, let's talk about Bitcoin. The original story, the narrative, was that it would be this revolutionary new kind of digital money, a peer-to-peer electronic cash system. And that was a powerful story. But when you actually test that story against the cold, hard data, a very, very different picture starts to emerge. So look, economists pretty much all agree that for anything to be considered money, it has to do these three basic things. You have to be able to use it to buy stuff, it needs to hold its value over time, and it has to be a common yardstick for prices.
All right, so how does Bitcoin do on that first test? Can you actually use it to, efficiently buy a cup of coffee or pay your bills in the real world?
The short answer? Not really. I mean, the difference in scale here is just staggering. The entire Bitcoin network handles about 500,000 transactions a day. Visa? It does that many transactions in less than 8 seconds. It's slow, it's expensive to use. As a payment system, it's not even in the same ballpark.
Okay, so when the first story didn't quite work out, the narrative shifted. Suddenly, Bitcoin wasn't for transactions. It was digital gold, a safe haven to park your wealth. But, this story also kind of falls apart when you look closely.
So here's the deal. It fails two really crucial tests. First, it's incredibly volatile. An asset that can lose a fifth of its value in a month isn't a reliable store of anything. Second, it's not actually decentralized. I mean, when 95% of the supply is controlled by just 2% of the accounts, that's not distributed power. It means the price can be easily moved by a really small group of people.
But hey, we don't have to just rely on theory here. We have a real-world experiment we can look at. Back in 2021, El Salvador made Bitcoin legal tender. They pushed it as the future of finance, especially for people sending money home from other countries.
And the results? It was a spectacular failure. The government made it law, they gave out free Bitcoin, and after all that, 98% of people still use the old school systems. When people had a clear choice, almost no one chose Bitcoin.
So, if Bitcoin fails as money, where does its value come from? Well, it comes from this very old idea in finance. Its price depends entirely on the belief that someone else, a greater fool, will buy it from you for more money later. The value isn't in the tech, it's in the hope of finding that next buyer.
Now, if Bitcoin is based on belief, what about the rest of the market? This whole idea that a story can overpower fundamentals, well, it's not just for crypto. In fact, a much bigger version of this has been the secret engine of the entire global economy for the last 30 years. And it's all thanks to something almost nobody talks about.
So after Japan's economy blew up in the early 90s, it basically went into a 30-year slump. To fight it, the Bank of Japan slammed interest rates down to zero, essentially making money free to borrow. And this created a massive, massive opportunity for investors all over the world.
The strategy was beautifully simple. It was called the yen carry trade. Investors would borrow trillions of yen for next to nothing, swap it for dollars, and then buy U.S. assets that paid a higher return. This became a fire hose of cheap money that flowed into everything, propping up prices for U.S. bonds, stocks, you name it, for decades.
And this quote from Ray Dalio just nails it. The bond market is the foundation for everything. And for 30 years, Japan was one of the biggest, most reliable buyers of U.S. bonds, which, in turn, helped keep all of our interest rates low. So what happens when that foundation starts to crack? Because that whole system is now breaking down. In 2024, for the first time in 17 years, Japan started raising interest rates. The free money is gone, and that whole trade is starting to run in reverse. All of a sudden, the simple math that pushed trillions of dollars out of Japan and into the rest of the world has flipped on its head. It's just not profitable anymore. So now, Japanese investors are selling their foreign assets to bring all that capital back home.
And this is why it matters to you.
When one of the biggest buyers of U.S. debt just disappears, it sets off a domino effect. To attract new buyers for all our government bonds, the interest rates on those bonds have to go up. And since your mortgage rate is tied to those, they stay high too. For stocks, higher interest rates make future profits worth less today, so valuations go down. It's like the oxygen is slowly being pulled out of the market.
Okay, so these deep financial tides aren't just market forces anymore. They are now literally being used as geopolitical weapons. And we can see this playing out right now in the global energy market.
You know, most people still have this 20-year-old picture in their head of the U.S. being dependent on foreign oil. But that world is long gone. The shale revolution completely flipped the script. The United States is now the #1 oil producer on the planet. And this changes everything about who wins and who loses during an energy crisis.
Take a look at the Strait of Hormuz, the world's most critical choke point for oil. If there's a disruption here, it creates what's called an asymmetric shock. As you can see, a whopping 75% of that oil goes to Asia, while only 2.5% goes to the US. For America, a crisis there means higher prices, which is painful but manageable. But for Asia, especially China, it's a devastating supply problem.
So the United States now holds this incredibly unique position of strength. An energy crisis that cripples its manufacturing rivals in Asia actually gives a boost to the U.S. economy through its own energy exports. Their pain becomes a direct gain for parts of the American economy.
And the timing of all this is really critical. China's energy vulnerability is hitting its peak at the exact same moment that these tense trade negotiations with the United States are reaching a boiling point. It really suggests that the energy shock isn't just a crisis, it could be a very powerful source of leverage.
And that leaves us with a final question. When an economic shock hurts your main rival more than it hurts you, that shock becomes a weapon. The hidden forces of finance and energy are no longer just shaping our markets. They are the new weapons and the new battlegrounds of global power.